If you're watching this, let me know below if you've ever been in a market crash of longer than 2 years, where the crash actually lasted 24 months. Have you been through that? Has your portfolio ever been through that? Because today I'm going to get into global market macro risk. And this is really my forte. So for those that are interested in market risk that may or may not affect your portfolio, you're going to want to tune into this short but very extensive covering of macro market finance as it starts right now. Welcome to Macro Market Monday. It's March 16th. That's a lot of M's. And I'm going to get right into what I want to cover right away. The first thing I want to cover is the facts and stuff of the market, what I watch for market risks. So what are they? And the big reveal here is, let's see if I can do that. The big reveal is the first thing I watch is institutional money. Why institutional money? Because they have the data that I have. They know how to value a company from a fundamental side, from a technical side, and I'm going to cover that next. But they look at the data, they know how to put comparables together and value the company and see if there's market risk attached to the company or the index. It's because indices drive prices higher or lower, not individual companies. So I have been noticing online the hedge funds, institutional money, they've been flipping to the downside. And how do I know this? Because I look at the put-call ratio. And puts are bets against the market, calls are bets for the market. That means that institutional money, hedge funds are hedging. So they're long. They have long positions, but they also have shorts. So that's really interesting to me. And I've been monitoring this really closely. The S&P put call open interest, that's what it stands for, is 51x skewed to puts. Smart money is already in. QQQ, that's the NASDAQ 594 puts with implied volatility at 25.2 are still cheap relative to tail risk on the table. You don't have to understand that. That's not financial advice. I'm just saying that institutional money is skewed to the puts, and a put option is a bet against the market. That's all you have to know. Reveal number 2. Oh, let's just do 2 and 3. Fundamentals are overvalued. What is a fundamental? Fundamental is a PE, a PS, price to sales. It could be enterprise value over EBIT. There's a lot of earnings before interest and taxes is EBIT. There's a lot of great fundamental research you can do within the company to see if it's over or undervalued. But the simplest one is forward PE. Historical PE also okay, but forward PE means we're looking into the future. And with a forward PE, I did some parsing on Grok. Today's macro market PE today, March 2026, is 21 to 23x earnings. To give you a frame of reference, in 2022, another quote-unquote bear market that lasted about a year, I said in the front of the video, have you ever been in a bear market that lasted over 2 years? Because there's really only 2 that stand out, and I'm going to get to that later. But at the beginning of our short bear market in 2022, we were 21 to 23x, the same as where we are now. And then we go all the way back to the derivatives and real estate bust cycle, and I wanted data before the bust. So I said beginning of 2006, 16 to 18 forward PE. That's a lot lower than our multiples here, which we got a nice crash in 2022 and a recovery in 2023. And here, okay? And then I said, well, this is really good information, but give me the PE of all stocks forever in the last 100 years. And I got a 16x. That's what I wanted to know. Is like, okay, the PE of everything is around 15 to 16 average trailing PE. So that's what Grok gave me back. And I don't disagree with that. And finally, the technicals are also starting to flip around. Let's go over to the technicals. This is an S&P 500 index on the daily, okay? Because the daily, I wanted the 50 over the 200 I may cross. I wanted the death cross. But I put this on a weekly chart so that all these can be seen easier. So keep in mind, this is a daily 50 over 200 death cross, all the instances and what happened. Of course, this was the tariff 2025. This was like not a recession. This was not a bear market. This was a one-off event that the market reacted negatively to. This was the quote unquote bear market of 2022, which bottomed and had a nice real quick turnaround in 2023. So it really, to me, it's only a year. And this is the COVID crash, which was really, again, short-lived. So what I'm trying to instill in you is that all these crashes have been short-lived, and they've been short-lived because of liquidity. They just flood the market with liquidity, which depreciates your dollars, which means you have trouble paying your bills at the end of the day, month, week, year. You know, it hurts you guys to flood the market with so much liquidity. But that's what they've been doing in COVID and then here and since 2008, really. So let's go back to that and let's put this on a weekly marked. And we could see this is a prolonged bear market. This is really 2007 to 2009. So 2 years. And this is also a prolonged bear market of 2000 to 2003. This was even longer than the financial crisis, which was much worse. Much more value got wiped out. Why was this longer? Because they didn't have QE back then, and now they do. And then your question should be, well, Macro Ghost, won't they just use QE again if we get nukes, if we get a huge crash? I don't know. I don't know how much longer this can work because it leads to rampant inflation. So this is something I'm watching on a technical level, is on the daily chart here. And then these indicators, as you can see, are flipping around here. And it doesn't look good. The arc is not upward sloping. It's starting to be downward sloping. And probably May, June, July, if it goes on this trajectory, if we go even lower, we're going to have a death cross. And we could see the end of the bull run. I mean, and what do I mean by that? Well, I mean, since I characterize this here, September of 2000 to 2008 as one bear market. So this is a sideways bear market. So the bear market started in 2000 and ended in 2008. And in general, in the past, we get around 18 years of good and 6 to 8 years of bad. We've had 18 years of good. So could this be a macro top? I'm not here to call tops. This is not financial advice, but I'm saying I am looking for it. I am long in my portfolio, but I'm also putting hedges down. Okay. So what hedges are the best? Well, the financial technology has advanced so much in the last 4 to 10 years that we can now be short by buying a fund, by buying the S&P inverse ETF, ticker SH, I believe, and the Dow Jones inverse ETF, ticker DOG, which is nice, you know, like an underdog, or like it's just a dog, you know. So if you want to, I'm not saying do this. I'm saying if you want to protect yourself from downside, you can look at the level here of 7,000 on the S&P, and I believe the level on the Dow was 50,000. And you could say, I'm going to stop loss on my inverse ETFs if it gets above that. And that's a really great idea. That's what I'm doing. I'm also doing some alpha added ETFs, Netflix inverse ETF, and the AI. It's called AIBD. It's an ETF. The ticker's AIBD. It's AI Big Data Inverse Fund. Because if we just go back, I'm just looking at fundamentals here. So I'm using, as an analyst, I'm using fundamentals plus technicals, which rarely people do online. You're not going to see too many YouTube channels say, oh, the fundamentals are this, and then the technicals are this. Let's put them all together with the put-call ratio and add value to the market. So if you're still here for this important video, please like, comment, and share, because that's how I spread, that's how I get noticed, and that's how I provide more value to the world. And the last one is retail is trapped. Nobody is taking profits. Ask people around you at work, are you taking profits? Are you in cash? What's your portfolio like? Is your portfolio at all-time highs? Because most people's are. They're at all-time highs. And it would just be a smart move, in my opinion, to diversify. And one last piece of information, so stick with me here. It's not just equities. It's not just stocks. It's not just Bitcoin. It's not just crypto. It's everything. So I'm aware of an everything bubble possibly showing up sometime between now and 2030. I don't know when. I can't call tops, but this guy, No Limit, he's on Twitter. I'll just give him a plug right here. You could follow him. He's really interesting. He gives you the facts by the chart. So, and in this, it says the U.S. housing market, this gap has never existed before, ever, including 2008 derivatives meltdown, which pretty much sunk the world. Sunk Greece, sunk Spain, sunk Italy, sunk Iceland, sunk every European country. That was originated in America, ladies and gentlemen. So When that happened, everybody went belly up on their mortgage, and there's never been more